Welcome back to the course Introduction to Commercial Banking and Fintech. In this particular course, we are going to we were discussing about the camel analysis, and we are going about the integration of camels and how the camel indicators have to be explained and the supervisory view. So one is that we are seeing that A and C are combined, because the moment A deteriorates, it impacts C directly. So these two indicators are interlinked. Your liquidity is linked with E, right. So this is what here we have the equity side, earnings side. So liquidity is impacting the earnings, and earnings deterioration, the overall it impacts the internal capital building. Governance is also impacting the E and L, and governance is something which is directly linked. So governance here could be a macro indicator for A, C, L and E, and this is where it is. So increase monitoring intensity and stress testing frequency, review underwriting and recovery practices, monitor deposit concentration and funding structure, and strengthen governance and operational control. So this is what here we have. So camels, if you try and understand that how it is linked, so you can say that this is linked with supervisory, this is linked with supervisory, this is also linked if the particular firm is not doing good on the asset quality. So there will be a call for PCA, prompt corrective action, and earnings are also directly linked. So overall, this is the overall picture of it. So in practice, so a weakness in one pillar propagates like A, if it is going to deteriorate, then this will deteriorate C and E, so capital and earnings. L is directly linked with the capital, and this is where it is. So rules of thumbs are the important rule here, but there are other conditions that can be further augmented and seen. Here the question that we have to ask before conducting this is that whether the GNPA or ROA are sufficient to build the capital, whether the management signals lead the cycle. So this is how the CML, the camel, has to be done. So this I think we covered a lot. So this is for you to understand, but I think in the camel analysis, one has to first check on EA, then earnings. These two combined will have the impact on C. C will have impact on the liquidity. So this is what here, and M is shaping the overall outcomes of all this. So this is how it has to be explained, and this is how it has to be understood. Now, one also a good thing about this is that you can also see not just cross sectionally, you have to analyze the camel data. It is better to analyze over a period of time with certain time period in mind, because those factors also play a very important role. So which means that persistent decline in capital or profitability, how it signals the emerging risk and how the thresholds are met. The asset quality trends, so which means that slippage, recoveries and restructuring, how they are going to go. The liquidity ratio, whether they should be assessed together to changes in the funding composition. So it is how it is linked. So level analysis is how whether the bank where the bank is today and how and where the bank is moving. So over a period of time, so this could be your cross sectional analysis, which means that at a point of time and this could be your time series analysis. So maybe in 1 year the company did not do well on A, but after 2 to 3 years it worked on A, and as a result we are seeing that the A has improved. As a result, you will find that C has improved, L has improved. So the temporal analysis helps a lot in making the right decisions rather than just the cross sectional, and this is what I am trying to explain here. Now if you have to think about the stress testing, I think in the climate sessions that we were discussing, I discussed the stress testing part also. So here one is the camel that prepares you for the stress testing. So now we are going to see that how the stress testings look like. So you will have to first create the stress scenario. So what are the scenarios? So one is the credit shock, then another is the liquidity shock, and third is the market shock, right? So credit shock could be because of A, the asset quality, and maybe the L also, or E. But A is the most appropriate here. Liquidity shock is the L, of course. Market shock, the sensitivity that we measure, that how transmission channels are like rate losses, reduced capital ratio, because CET1 will be lower. So as a result, the capital adequacy norms is going to be lower, because capital adequacy norms is nothing but this total capital upon the RWA. Funding stress compresses earnings through the higher cost. Market valuation changes affect both earnings and capital, and this is how it is. So stress testing complements CAMLs by introducing a forward-looking assessment of the resilience. So this is where it is very, very important. Now, there are other indicators which play a very important role. For example, additional signals that here we have. So how can you measure? So we can go by measuring the equity volatility, right? How we can go? So maybe you can take the time series data. So suppose I go by, in India we have something called BankX index of the banking sector, and you can see Nifty 50 or Sensex 30, right? Now what we are seeing is that you can do by two ways, that you can download the suppose daily data or weekly, right? And then you can go for calculation. So one is the rolling standard deviation you can do for volatility or standard deviation. So rolling variance you can do, because rolling variance is nothing but x minus expectation of x, right? So this is what we call it of whole square, right? So this is what we get. For covariance it will be y minus, so cross product, you can write it in this way, expectation of x into y minus expectation of y, that close, right? So this is what we call it for the covariance, right? So this has to be closed, right? So x minus x into y minus y bar, right? So this is what we get. Now here what another approach is that for in order to maintain the equity volatility, you can run something called time varying volatility models. What are those? So this is Garch and MGARCH kind of setup. So generalized auto regressive condition heterogeneity. What you have to do is that calculate the returns of the bank X and run the regression against that. RT minus 1 plus epsilon t. Then you take the residual of this alpha 0 plus beta 1, epsilon is square t minus 1, square of this residual, plus beta 2 sigma square t minus 1. Now here those conditions play, but if you extract this particular value, so this is what we call it as the, given these values you can calculate sigma square e, and this is the good proxy for time varying volatility. Then the next indicator is the bond spreads and funding cost. So this is also one. Then we can also calculate through the distance to default that we have already discussed. And while discussing, we also discussed the distance to capital, right? So this implies this. So rapid credit growth related to the deposits, increasing sectoral concentration. So this is what it implies. Deteriorating loan performance at early delinquency stages. So this is how the early warning indicators help you understand. So there are different advanced models of measuring the early warning signals, but I hope these signals are enough. You can also go for the co-wire that we discussed, MES, S risk kind of variable. So this is where it is very important. Now here in most of the cases what we find that the camels are helpful in the supervisory standards, especially the systemic risk and the macroprudential tools to measure, right, and this is what it helps. And overall, so for example, if you have taken the data of suppose 15 banks and you have the time series data of all indicators of camels, now you can see among all these 15 banks, which consist of both public and private banks, which bank is under stress and which bank is not, and which bank is doing well and which bank is not. So this becomes a very interesting exercise. Then microprudential versus macroprudential perspective, so how it plays safety and soundness of individual institutions, how it plays a role. The macroprudential, there are other kind of models like interconnectedness based on, if you know, the network models, right. So network, like how do you try to explain with regard to the adjacency matrix, adjacency matrix, right, with one explaining another. For example, if I go by sigma 1 sigma 1 2 sigma 1 3 sigma 1 4 and so on, so how the sigma 1 2 explaining, so with this node and edge, so this will be the node and these will be the edges, so how they explain and how they are interconnected, right. So this could be like this could be like this and so on. So this is how the interconnectedness models are very much popular these days, and there are a lot of models. Contagion risk, that we know that when an event has occurred, so what has led to the, whether this event has led to the increase in correlation between two banks or the set of banks, so this is the contagion we say. Systemic resilience, that whether though there is an event occurrence and whether this event occurrence is impacting whether it has whether the banks are having sufficient capital to immediately minimize the risk of such event occurrence. So this is where it is important. The camels provides structured diagnosis at the bank level. A stress test, market signals and all those factors play a very important role. Now this was the overall summary of the camels. So we analyzed with different dimensions that how the camel analysis is important. But if you are learning for the first time camels, I request you that you can take up this as an assignment of yourself. You can get the data of suppose 10 banks on all these indicators. You can find them in the balance sheet or you can calculate given the ratio, because you can easily do it, and then you can analyze based on rule of thumb and easily find out that which bank is under stress and whether you should keep your money in that bank or not. Some of the data that will be useful for the camel analysis is available on the RBI website, RBI database on Indian economy, and you can go to the banking indicators and you will find all the data available for the CET, risk-weighted assets, the liquidity and all others, and you can also calculate those numbers and find out. If you are already masters and you already have the access to financial databases, like for example Bloomberg, Refinitiv and the bank scope, then you can directly download these indicators and work as an assignment. So this could be a good learning for you, and rest of the things we have already covered in different sessions so far. So you can refer to those videos again and easily can connect that what is the role of camel. So camel is very simple analysis, but since we are doing it for the first time, so I explained that with different concepts and different dimensions. Now we are going to start a new topic which is related with what we call it as the bank efficiency. Why measure bank efficiency, what it means. So efficiency measurement, basically it helps you understand that given the input that you have, can you maximize the output, or given the, in case of cost it will be mean function in optimization. In case of profit, it could be the max function subject to input, right. So these two dimensions are very important. So there are two ways to measure. One is the parametric, another is non-parametric. Parametric in the sense that when we write a model in the form of the reduced form setup called the regression equation, then we call it as the parametric. If you are just going by simple calculation of the or derivation of the indicators based on the optimization condition mean max, then we call it as non-parametric, because you don't require as such. You can simply go for optimization technique and work on. So in the if you ask anyone, those who work in the area of banking efficiency, so those who are in the field of those who are doing a bachelor's, for you it might be a bit advanced, but those who are doing masters, you must understand if you want to work in the area of banking research or you want to get into the banking sector domain. But those who are in bachelor's, it is also a good opportunity to update yourself, that update to the frontier of the research that are being conducted in the area of banking. So one is called data envelopment analysis. The envelopment is basically with regard to the input output scenario, that whether you are above the frontier or below the. So envelopment, we are basically talking about that. So it is a non-parametric efficient frontier. Then here we have the stochastic frontier, which is the parametric, and it also measures the efficiency, but with certain conditions. So that we will touch upon. So let's start with DEA. So efficiency, if somebody will ask that how do you define efficiency in the case of a bank. So how close is a bank to best practice performance given similar resources? For example, technical efficiency, producing maximum output for given input. So this will be max, right, max pi. Cost efficiency, producing the target output at the minimum cost. So this will be mean, right. So mean of C, right. So this is what here we have. Now scale efficiency, operating at efficient size, that how do you go for. So there are n number of variants of these models with certain conditions. So it may not be possible to touch upon all those technical details, but I have tried to give in a very snapshot way the understanding. If you want to get into in detail, you can just search online. There are n number of documents available, papers available on this, and you will be able to do it. So best performing banks define the efficiency frontier, and other banks are measured relative to this benchmark. So this is what. So the frontier that we are defining, it is based on the efficient best performing. If you are below that, you are not doing better. If you are above that, then you are better than the best performing, right. So this is what it implies. So the core idea is that it is no parametric approach. So functional forms are not very strict. You can be flexible and you can work out with the square, non-square, simple, linear, non-linear. So but a lot of time the DEA analysis is the field of operational research, and there we find that the linear programming concepts are very helpful, especially because we have the staggered system. So it helps a lot. So efficiency is measured related to the peer institutions. So a score is 1 indicates the best practice, and a score is less than 1 indicates the improvement potential. So this is what the DEA looks like. So DEA input output, you can consider this. So typical banking will have the labor, the employees or personal cost. If you remember, we had discussed this, the non-interest expense, right. So when we're discussing balance sheet, so at that time we discuss about the inputs. The inputs are the employees or personal cost, branch network and fixed asset, land and buildings and others, funding and operating expense. If the bank is borrowing from other banks, then how much price it is paying and what is the cost of that payment. So this implies the typical output, loans and advances, deposit payments, services and others, and fee based income, right. So output could be like how much it is generating the loans and other things, advances. So credit creation kind of setup. Deposit and payment services, that how efficient is the bank in mobilizing sufficient deposits so that it can create loans and advances. And fee based services, that could be based on the volume of transactions. So this is how it gets into. Then two common perspectives, as I mentioned, that input oriented DEA, the input can be proportionally reduced while maintaining the current level of output. Output oriented, extent to which the outputs can be proportionally expanded using the existing level of input. So this is what it focuses on, maximizing production or service delivery. So this is what we get, and commonly used for when institutions are aimed to expand output or improve productivity. So this is how it means. Example could be like, suppose if bank A has the single input, single output example. So bank A has 100 employees, and 100 employees create 1000 crore of loans they manage. Bank B has 100 employees, but it manages only 800 crore loans. Now output oriented DA efficiency could be like 800 upon 1000, so 0.80. So relative to the, so bank B produces 80% of the frontier output. So this is what here we have, and in order to reach to the frontier that they have, so since 100 employees are same but the output is different, so this particular bank has to catch up to 1000 crore. So this is what 25% to reach to the frontier. So this is, so this best performing bank is this in both the bank. So bank B has to catch up to become A, so they will have to increase 25% of the output. So this is how it goes by. So bank A has 100 employees, so 1000 crore, 125 employees, rupees 1000 crore loans. So here you can see the input oriented efficiency is 0.80, right. So bank B uses 25% more employees than the efficient frontier, and efficient frontier here is the best performing banks. So efficient input level will be how much? So 125 into 0, so 100 employees. So which means that they will have to now think about reducing the number of employees and then go by maintain the same level of the balance of the output, right. So this is where it becomes important. Now here we have another scenario. So I have tried to give a particular shape here in a simple way. So DA measures relative technical efficiency best in comparison to best practice frontier. So suppose Y is the output and how much is the observed output upon the frontier output. So this is what, so input into employees, this we drew here, right. So this we got here. So this is what it gets here, and it efficiency score varies between 0 to 1, and this is how it looks like. So this is what we try and get. So this we have done already, right. So this is what here we measure. So if you consider with regard to the both cases that we have, so we find that bank A uses more centralized credit processing and digital onboarding. Bank B relies relatively more on the branch level processing and manual workflows. And output oriented DA efficiency score for bank B, it is 0.80. So this is what it means. And how it has to be explained? So this has to be explained with in relative terms, that how a particular set of banks which are most efficient ones or most inefficient one are performing with to the best performing banks, and best performing banks create the frontier, right. So this is what, but the trouble part is that there are limitations on the deployment of this particular method on the type of data that you have. So certain qualitative indicators may not be suitable, and if you are putting so much of qualitative indicator, then it may create trouble. So this is where it becomes really a big challenge for a lot of people to work on. So in order to address certain challenges of this particular DA analysis, people thought about having the parametric setup, because this is the non-parametric, and this flexibility added a lot of dimensions, sensitive to measurement error and outliers, treat all deviations from frontier to inefficiency, and no explicit separation between noise and inefficiency. So this is how, so they distinguish inefficiency from random shocks. So this is how it deals with, right. So this is how we define. Now we are going to discuss one more angle, which is the stochastic frontier analysis. And in stochastic frontier analysis, as I mentioned, that as compared to the DSFA has certain parametric model based advantage, and it is based on how they measure the performance and how the observed performance reflects both random shocks and inefficiency. So this is how they define. So yi is equal to f xi beta and exponential vi minus ui. So this is how we are having. So vi is the symmetric noise term that we get, and then second is the measurement error. Then here the demand shocks, and then we finally try to get into the technical efficiency, and this is basically we are talking about inefficiencies first, so then we measure. The point to note here is that these are unknown betas and these are the observed variables. These are the differences that we are seeing with regard to the symmetric noise term, which is like measurement error, demand shock, macroeconomic conditions, minus inefficiency term, which means that how much it is deviating from the frontier. So this is how it tells, and if you see conceptually that how the model looks like, so it goes by this way. So symmetric random noise we create, right, and the ui is greater than equal to, so non-negative inefficiency term we get. I have given in terms of form, but you can easily replace form with the bank and see. So this is how it works on, and then they go by, since it is having the random characteristics, so we apply the panel data model of mostly the random effect, and then we try to measure through the maximum likelihood. As you can see that these are all variables that we are considering for the measurement, and then we finally conclude to this particular setup. For example, you estimated the output 1000 crore, observed output for bank is 860, and all the estimated parameters are these. Then we can easily see the technical efficiency by taking into account the exponential of minus 0.12, and this the value that you get is 0.89. So we can say that bank operates at approximately 89% of the frontier efficiency after accounting for noise, and this is where it is becoming very important to understand, right. So these are the efficiency term that we focus on, that we pay attention. And here we also can compare with the DEA. So DEA measures all deviations and efficiency. SFA says that as a statistical noise, and it is also creating a good set of indicator for the banking and other data, and this is where it is very important to note. And overall, if you compare DSA so DEA and SFA, so it is non-parametric that we have discussed already. The SFA is parametric. Noise handling is one topic that we discussed, so no separation, explicit separation. Functional form must be specified and not required. Outlier sensitivity, it is higher and lower, and these are the conditions that we touch upon. So with this, I am stopping it here. So I hope you enjoyed the particular session with more of the efficiency based parameter measurement, and CAMELS the rest of the section. So these two sections were based on the efficiency and other angles. So with this, I am stopping it here. Then in the next session we will be focusing on the banking research. Thank you so much for your attention. I really appreciate it.